If you're an advocate of the sell-in-May strategy for equities, things are not working out so far. Here we are, just starting out in the second week of June, and the equity markets remain buoyant. So, where now? Ron William joins us now from ECU Group Tactical, where he's a tactical strategist. Ron, welcome.
Happy summer greetings, Jeremy.
Good, looking forward to a summer if we can get it. But what about the markets over the summer? Because you work in these large, long cycles, and you identify periods of the year where things could turn lower. So far, the sell-in-May strategy hasn't worked out.
Well, yes, the pattern of the sell-in-May seasonality that we test ourselves quite vigilantly begins with a mid-peak out in April, usually around the earnings season, which we have seen, and then a flat month of May, but the real volatility begins in June, and more specifically late June. Now, the opening chart that we have shows how sell-in-May has worked most of the time during this current cycle from 2009.
Okay, it's the Dow Jones industrial average, isn't it, that you're looking at?
Yes, and this applies also on some of the other US indices, so it's a similar roadmap. But what it does show is that the average drawdown for sell-in-May during this time, when it has worked, has been around minus 10%, and that's from mid-April to the end of June. That's the short-term window that we measure. And what's important to keep in mind is that the equity market recovery since 2009, where we are actually measuring the seasonality pattern, is very overstretched historically. And just recently, it's broken its 2008 crisis record for the number of days without a 20% correction. So we have seen a 10% correction a few times, but we haven't seen that be-all end-all 20% correction, which would be quite healthy for the market. Now, there are important risk levels to keep in mind because we are so close to the all-time highs on the Dow, the Nasdaq, and the S&P, so all the large cap indices. And on the Dow, I've just put it there for 18,351. If for any reason the market were to be propped up on the back of maybe FANG stocks or Fed action, then of course that will change or delay this scenario. But the downside is what we favor the most at the moment, and that support level is around 15,370 on the Dow.
Yeah, as I said, here we are just starting out in the second week of June. We haven't yet reached that point at which you anticipate a drop. Let's move on to the second chart, because I know that this illustrates where things potentially could go as we work into June. Explain this one.
So this is us using statistics and probabilities to backtest this pattern, which begins mid-April, ends around the June time. And then, of course, we have the midsummer rally, and thereafter, usually a peak in August, which then leads us to the autumn crash cycle in September, October. So it's a staged process. And the first stage of that process is all about not sell in May, but actually sell in June. And that's where the volatility appears. So this is a back-tested graph of that move over consecutive June periods over many years. And what it shows is a lot of the volatility actually starts at the end of June, second half of June. Now, interestingly, it's not just the stats which suggest that, but also a lot of mounting event risk. If you think of the FOMC meeting, maybe less so in June, but more so in July. But certainly a lot of people will be listening to hear what the Fed has to say after the poor jobs numbers. Secondly, we have the Brexit referendum on the 23rd, Spanish elections thereafter. And last but not least, the month of June and July actually is where we start to see a deceleration in buyback spending. Now, keep in mind that buyback spending is the single largest demand factor in this equity market rise. If that starts to decelerate, that will take the floor out of the market, which has been holding it up so strong. So all of these different scenarios which might prop the market for a move down.
Yeah, I know as well, as I said at the top, you work in these large cycles. The presidential cycle as well is something else to consider this year, which I think on the next chart you introduce that as an element as well of the long-term picture. Explain what's going on here. Yes,
well, we always encourage using a confluence of cycles. So we believe in the domino effect, that the rising tide lifts all boats. And there are three cycles that we look at on a regular basis. The 10-year cycle, which is the decennial cycle itself, which we've spoken about in previous interviews. It's not on this chart. The 4-year cycle, which is more the presidential election cycle. Now, the way we're measuring it this year is to look at the final year, the last year of a second-term presidential election cycle. So Obama is a case in point. George Bush is another one. Clinton, another one. There's several double-term presidents, and in the final year they become lame ducks. The market tends to be negative. Their policy ammunition starts to unwind, and then the market starts to set up in a depressed manner for that new leader. Now, this year is even more synonymous because we've got uncertainty with Hillary and Trump at the helm, and a lot of the market's trying to work out what that might mean for the economy. But essentially, when we have the presidential election cycle, final year of a second term, and the seasonality stats there, both are bearish. And if a larger cycle is also bearish, that also skews the smaller cycle. And that's what we see here. We have a peak in Q2, a flat May, but which is a little bit positive. We've seen a bit positive, and then negative into June, with potentially a midsummer rally, which might be more muted this year, and then back down into that September-October drawdown period.
Okay, so remains bearish in 2016 for the big picture. Let's move on to a chart now. Those that have seen your past interviews, we've spoken about this before, where you analyse the bad, the good and the ugly. And just talk us through these key price levels to watch here, because you've got the three big indices in the States, the Nasdaq, the Dow Industrials and the Russell 2000, the broad market index. Yeah,
so we like to use Hollywood metaphors to try and bring out the message. And the good, the bad and the ugly really fit this kind of rotation in US caps, stock markets. The Nasdaq, the Dow and the Russell. Now the Nasdaq used to be the good, the Dow used to be the bad, and the Russell the ugly. It seems to have reversed now with the ugly market, Russell 2000, actually making new multi-month highs as we speak. So there seems to be this stealth kind of bullish signal on the Russell 2000, but it is losing momentum, and we're not sure how long that move will hold. Even so, the message behind this chart is to keep your eye on that rotation. And ideally, you'd want to see rotation supported across the board, suggesting that it's a sustainable move in the market, either up or down. So right now, it's only the Russell 2000. We're looking for confirmation on the Dow and the Nasdaq. And the key levels to keep in mind, 1205 on the Russell 2000. This is a risk level to keep in mind. Of course, the all-time high as well at roughly 1293. On the Dow, 18,220 is a risk level produced by an indicator that we look at, the DeMark exhaustion signal. And the all-time high on the Dow is at 18,351, which we saw in the earlier chart. And then last but not least, on the Nasdaq, 5,000 is an important level, with 5,231 being the all-time high on the Nasdaq. Now remember, on the Nasdaq, that's the 1999 all-time high, so that's even more significant.
It's incredible how close we are to those highs.
Well, yes. I mean, if keeping in mind that the infamous FANG stocks can still prop the market up, and any kind of Fed activity will also add some more pressure, but that could also be quite bearish too. We'd want to see a weekly or monthly upside close to suggest that this scenario is either delayed or just plain wrong. But for now, our core scenario, strategic scenario, is bearish this year and next year, and that's across cycles, long-term, medium-term and short-term.
Good. Okay, all right, Ron, we've got to leave it there, but thanks indeed there for joining us. That's Ron William from ECU Group talking us through the summer and how things could pan out. Watch out for that last couple of weeks of June.